everyone. I'm Maria Halasz, and I'm the CEO of Stride Equity, a venture-backed equity crowdfunding platform. Welcome to this presentation on how to utilize venture capital and equity crowdfunding for accelerated growth. I want to thank Wholesale Investors and Capital HQ for the opportunity to provide this presentation to you. Before I start talking about the utilization of these different options, I just wanted to flag quickly what are the potential options for funding at each stage of your company's development cycle. And of course, the really early stage, the pre-seed stage, the first option is to bootstrap or self-fund, following which you might get the 3 Fs, the family, friends, and fools investing in your business. And of course, at that stage, if you are advanced enough, if you can convince angel investors or other external funding options, syndicates, then it may also be an option for you. At the seed stage of development, certainly venture capital, equity crowdfunding, and also angel investors become options for you. In terms of Series A, which is a more advanced stage of your company, you would have a market fit and the ability to really show that you can grow and scale, and you have revenues and potentially even profits. At that point, venture capital and equity crowdfunding remain really good options. Whilst at the latter stage, which is Series B and Series C and beyond, venture capital, private equity, of course, remain very important options to fund your business. And of course, you might want to consider an initial public offering or a listing on a capital market. So in terms of the money that has been invested in Australia at different stages last year, and prior 3 years, you can see that the majority of the money has gone into the Series A and Series B investments in companies. And whilst angel, pre-seed, and seed investments are much lower, they do represent a solid amount. And of course, these companies would require lower capital injection in any event. Last year, we've seen the venture market shrink from more than $7 million to about $3.5 billion. That has been invested across 413 deals by our funds. And of course, that's a 54% drop from the 2022 levels. The market has become slightly more competitive. Almost half of the investors felt that the pre-seed and seed stage deals became more competitive, but only 19% of investors felt that the Series A and B deals were more competitive. However, with the IPO option not really being available and a lot of built-up capital in the funds, Series C deals became also less competitive. Angel investing is the first option, of course, when you start looking at what are my potential options to fund my business. And whilst it's not a consistent and easy to find group of people, there are many, many angel investor syndicates that are out there in Australia and overseas today, and they're growing consistently. In fact, over 330,000 angel investors invested in Australia so far, and there's a strong rise that you can observe over the last 10 years. In particular, under 40-year-olds. So that's a generation that is really started investing. As the number of technology companies started proliferating, you see the interest of this generation in those companies has been intensifying. And a lot of these investors feel that in the coming years, they want to remain remain on the market and investing. So it's a really good opportunity for you, especially if you've got an earlier stage company to go and seek out. One of the points that is important to make is that angel investors don't just invest by themselves as high net worth investors or in groups or syndicates, but they might invest together with venture capital groups, or they might invest through equity crowdfunding platforms. This slide is up to 2022. We don't have an updated information on that. And you can see it's a little bit up and down as far as the applications, a number of applications for angel investment is concerned. And that's mostly around probably the unavailability of reliable data. However, the applications are pretty consistent, and the funds invested are pretty consistent from an angel investor source. When you look at the landscape, and these are just some examples of the angel investor syndicates that you can find. It's very, very easy to find them. You go to their platform, you look at their offering, you see the conditions and terms of how much it costs you to raise money through an angel syndicate, and then you can make a decision very easily. These are quite transparent groups that you can approach for funding. The next opportunity for funding is crowdfunding. In Australia, you can look at donation-based, which is really not issuing equity for anyone. It's really, you might have a very special humanitarian project you want to raise money for, and that is a donation-based crowdfunding. There's a rewards-based crowdfunding option, and that is if you want a very specific, exciting new product and you offer that product or a discount on that new product once it's available to your investors, then that's a reward-based crowdfunding. And of course, the most common and highly regulated form of crowdfunding is equity crowdfunding. To get to equity crowdfunding, you really have to be pretty certain that you've got a defendable product, service, or platform. You demonstrated early product market fit, that you already know where your customers are, who they are, what the economic numbers are, what is your business model, what is your pricing by and large, and what works on your market. And most importantly, you really have to have your legals sorted. Your company needs to have a constitution. You need to be in a position to be able to issue shares for your new investors. So what is equity crowdfunding? It really is accessing investment, equity investment from retail investors. So it's not different to angel investment or even a VC investment. The difference is that you've got more investors because the individual investment by these investors is usually lower amount. So instead of a venture capital putting $500,000 or $2 million into your company, we're looking at retail investors who can put up to $10,000 individually into your company. You can raise up to $5 million annually through equity crowdfunding, and that can be a standalone investment, or if you really want to boost your growth and you're going to need more investment, it's a great opportunity to syndicate equity crowdfunding with angel investors or VCs and really put a larger pool of capital together. It's really important that you prepare a strong disclosure document, and the ASIC regulates equity crowdfunding, and there are licensed platforms that can conduct these offer campaigns, and the disclosure requirements are quite significant in as far as your business, your financials, and your prospects and your risks and how to mitigate risks are concerned. Very importantly, when you raise money through equity crowdfunding, you're going to become exempt from the usual limitations of 20 shareholders for a private company or 50 shareholders. And so your ability to take 200, 300, 400 investors into the pool and still operate as a private company is there. The only restriction is that if you raise more than $3 million, you do have to audit the company once a year. Equity crowdfunding has become quite significant in terms of how very early stage companies raise their funding. And in fact, every year in the last 3 years, it leveled out, whilst, as we saw before, both angel investment and venture capital has slightly dropped back. Of course, venture capital dropped back significantly, like 54%. But equity crowdfunding seems to be quite stable. There is a pool of investors who continue to be interested in quality offerings. So equity crowdfunding in intermediaries raised around just under $300 million for early stage companies since 2018, when the first licenses have been issued by ASIC. So the industry is very young. There's much more growth and opportunities there to access that pool of investors through equity crowdfunding. And in fact, if the government really will go ahead and makes the requirements for wholesale investors significantly stricter, equity crowdfunding is an option to access those investors that will fall out of the wholesale investor, sophisticated investor basket in the future. Those investors will still be available to invest in your business through equity crowdfunding. Currently, we're looking at just over 100,000 people in Australia actively investing through crowdfunding platforms. And when you compare that to the close to 10 million ASX investors, retail investors, then there's quite clearly a huge gap, and there is an opportunity to grow that number significantly with quality offers. And in fact, to be successful, you increasingly have to be well organized, more advanced in your business, really well structured, and have product market fit, have a solid management team and board, and really show execution capability in your business. There's also an alternative equity crowdfunding model, which is the Stride equity model. We are a venture-backed equity crowdfunding platform. What this means is either we invest through our own funds or we provide cornerstone investment prior to an investee company going onto the equity crowdfunding platform for an investment from retail investors. We normally, when we see a company, and the vast majority of companies don't go through the process successfully, we do due diligence. To us, it's really, really important to show execution capability. So we need strong management and founders. Obviously, a great idea is great, but there's many, many great ideas out there, and strong execution is the key to business success. Very often you see businesses pivoting from one idea to the other. Doesn't mean they're not going to be successful. However, if the management or the directors are not able to deliver, then nothing will save a good idea. So to us, that's very important. Once the companies go through our due diligence process, we either secure cornerstone investment or invest ourselves, and we put essentially a campaign through our platform, our licensed platform. Initially, it's in the form of an expression of interest campaign where retail investors can show how much they're prepared to invest in your business, following which we go into an offer campaign. At that point, an information memorandum is a proper disclosure document is provided to retail investors. In the crowdfunding landscape, you see a number of companies. There's about 14 or 15 licenses that are out there today. We see 6 to 7 players that are active in the market, and they're all very, very different. So before you engage with an equity crowdfunding platform to raise capital, it's a good idea to look at what their characteristics are, what their focus is, whether it's industry type of investment or the investor base that they're talking to. And now we talk about venture funding, and venture funding can be early or late stage, and also venture debt, which is becoming increasingly important to access for companies that are not able to secure venture capital, but perhaps are at that stage of growth where they can show strong revenue and perhaps even profitability. So we've noted that venture capital has fallen from 7.4 billion to 3.5 billion between 2022 and 2023, and the deals also fell significantly. I think the existing investee companies had a lot of pressure last year to become more efficient. The investments that have been made at a lower valuation, and of course, they were probably smaller than anticipated by companies. So their investee companies have been under significant pressure to make themselves or get themselves closer to profitability. And I think this will continue to be a focus for venture funds when they look at a company. How close are they to profitability? Now, last year has been slightly traumatic, and as we all witnessed some of the failures, 40% of the VCs reported that they've had failures, and 90% of the investors witnessed layoffs within their portfolios. However, the good news is that investors expect deal pricing to stabilize this year, according to Fulcro Ventures report, which is the reference for most of the numbers that I'm quoting in this report. So this is just the venture capital raised over the different years. And in 2022, we had a big anomaly. About $1 billion was raised by Blackbird at the very end of the year. Otherwise, as we can see, barring a few really bullish years, we can see that there is a leveling out of the raising of this money as well. And that just is reflective of the institutional investors' appetite for very high risks long-term investments. This is really just a summary of what we've discussed. I think what's important to understand is that there is probably an overestimation of the dry powder that is in VCs. Although they're really keen to invest and they've got money to invest, they also have very hungry investee companies that will continue to need funding as they reach their various value inflection points. Concurrently, IPO activity remains sluggish. Last year, there were only 45 companies IPO'd as opposed to around 120 the previous year. And so we're really seeing a quite conservative IPO market, again, until the macro environment is changing and becomes more positive. This is unlikely to change. So there is a significant demand on existing VC funding. And whilst the number of VC funds are raising external capital, these are smaller amounts and certainly not in the billion range that could make a significant difference to growth companies. Very important to note venture debt. And this is an area that many people tapped into, many companies tapped into. This is money that comes in the form of a loan. You really need to have revenue and ideally profitable or close to profitability, and you have to repay that cost. This is a shorter form of funding, 3 to 4 years, as opposed to venture capital, which is 10 plus years in most cases. In 2022, there was a record year for debt funding as it is a very attractive non-dilutive way of capital raising. And this is just the venture debt amounts. And as you can see, 2022, 2023, they leveled out. And of course, it's a really interesting way to fund growth when you're very specific about your numbers, where you really know the market and you secured customers. So that's definitely there for companies that really just want to scale into a specific market or grow in a very targeted way. 74% of VCs, in fact, reported that their portfolio companies took on venture debt last year, and 5% of the surveyed startups have taken on venture debt in an early stage of their development. This is the venture capital landscape, and of course, Blackbird, Airtree, and SquarePeg are the three large funds. Tractor Ventures provides venture debt, and I understand they're currently raising further funding. So this is definitely a source of funding that people should be looking at. When we look at corporate venture capital, it's really companies like Telstra Venture or funds like Telstra Ventures that can look at any stage of investee companies so long as you fall into their investment criteria. So I want to thank you for your attention today. I also want to thank again Wholesale Investors and Capital HQ for having me to present on options on how to fund your company into growth and scaling. My name is Maria Halasz, and my contact details are on the screen. You can reach me on my email, halasz@strideequity.com.au, or on phone if you have any questions. Thank you again. Bye-bye.